Hi, I'm David Marchant, the founder of Offshore Alert, which investigates participants in high-value cross-border finance with an emphasis on high confidentiality jurisdictions. Our specialty is exposing investment fraud while it's in progress. Enjoy our content.
Well, good morning, everybody. Thank you for joining our session. This is Jonathan Sabloni at DLA Piper in the session which we've entitled Redo. And we're going to talk today about the credit crisis that hit in 2008 and some of the similarities we see and we think we might see following the economic downturn related to COVID-19. So first of all, let me welcome everybody and thank you for joining, at least virtually. I know many of you, although I can't see you, so I'm sure you're out there. It's great to have everybody back in one place. We're really excited about today's session because we believe that this area in the dispute space, especially related to offshore and alternative assets, is going to dominate the conversation for many years to come, similar to what the credit crisis did. So let me introduce our esteemed team here and panel, both of my colleagues from DLA. First of all, many of you know me, but if you don't, I co-chair along with my colleague Jamie Curl in London, the DLA Piper private fund disputes team. And I've been handling both offshore disputes and onshore disputes related to alternative assets for the better part of 20 years. Or probably closer to 25, and we're still, believe it or not, we're still cleaning up some of the matters that were filed after 2008 in the credit crisis and the Madoff downfall. So we'll bring some of that experience and perspective to the session today. With me is my colleague Chris Parker. Chris is the London head of restructuring at DLA Piper. His practice is predominantly focused on cross-border and contentious insolvency, and he's worked with some of the big names mandates over the years, including many years on Lehman, acting for the administrators of Lehman Brothers Limited in the long-running waterfall litigation. More recently on mandates including Abraj and NMC Health PLC. And also with us is my other colleague from London, Charles Allen. Charles is the legal director in litigation and arbitration team. His practice focuses on cross-border litigation and arbitration, principally in the financial services and energy sectors. He specializes in fraud and asset tracing work, principally involving the CIS, which will always be Russia and me, Middle East and Africa, often with offshore elements. And Charles is actually going to moderate today's discussion. And Chris and myself are going to give our additional perspectives. And so with that, I'm going to turn it over to Charles to kick the session off. Thank you again, all of you, for joining us. And Charles, take it away.
Thanks, John. Hello, everyone. Very, very nice to meet you all, albeit virtually. Over the next 30 minutes or so, we'd just like to give you an overview of the sort of litigation and arbitration we were involved in during and after the 2008 financial crisis, particularly in the funds, financial services, insolvency and offshore spaces, and on both sides of the Atlantic, and also to give you some insight into the sort of cases we're seeing now and how those differ from those we saw during 2008, together with our thoughts about what we see coming down the track over the next 12 to 18 months. And again, that's both on both sides of the Atlantic. So let's kick us off with 2008. I myself was only a trainee at that stage, and so my overriding memory of the crisis was perhaps not a happy one. It was a running around night after night, frantically assisting with company reorganizations and restructurings and other such delights. But during that time, I know that a number of partners in our London office, including Jamie Curl, who I think is with us, were involved in banking, litigation and financial services disputes relating to the crisis, and in particular, the swaps litigation involving Lehman, which Chris will talk about in a moment. So without further ado, let's get to our first question. How would we describe the financial services and investment fund disputes we were involved in during and around the time of and slightly after the 2008 financial crisis, particularly those with an offshore element? And perhaps, John, you could kick off the discussion on that.
Sure, thanks, Charles. And let me say that a lot of the things that we're going to talk about right now, but what we've been doing for the past decade, equally apply, I think, or will equally apply today. With respect to the offshore market, what came out of the '08 financial crisis was sort of the perfect storm, we called it at one point, or in some respects, a three-legged stool. We had issues in the fund space related to liquidity, net asset value, and redemptions. And they all played into each other. For those of you who remember, there was a massive quest for liquidity by investors, especially institutional investors, during the crisis. That led many of those institutional investors to submit redemption requests into funds, particularly hedge funds, both standalone funds, fund of funds, and feeder funds in the Caribbean and other offshore markets. And the issue with those redemptions were that the net asset values marked by some of the fund managers were, we'll just say, if not arbitrary, perhaps aspirational at best. And so you had a situation where you had liquidity concerns driving redemption requests that could not be met, both because of the liquidity of the underlying assets and the semi-unrealistic NAV projections that have been made by the fund managers. And that had the impact of causing both insolvency and straight litigation for both funds that were on the brink and perhaps not total frauds, but what we call fraud light, that maybe the NAV wasn't what it was supposed to be. But those three issues, liquidity, NAV, and redemptions, also brought down very healthy funds. Because there's no hedge fund, there's no private fund in the world that can sustain a very high percentage, a super majority of LP investors trying to redeem out their investments. There just isn't that type of liquidity even in the strong funds. So we saw strong funds going down. And a good example of that, at least in '08, was Madoff. Madoff drove a lot of the insolvency that I was involved in the offshore market, because many of the funds in those offshore jurisdictions had some exposure to Madoff, either directly as feeder funds or in a fund-to-fund structure where one of the underlying funds fed into Madoff. And so again, as Madoff, as people lost what they perceived as liquidity in Madoff, they began to make redemption requests in those healthy funds, and ones that had exposure to Madoff were doubly hit because they had lost huge investments at the same time their own investors were seeking liquidity. And then finally, in the sort of the overall picture following '08, we saw on the onshore side, we saw asset-backed securities and collateralized debt obligations hit particularly hard. We saw this primarily in the RMBS market, which was residential mortgage-backed securities. And in fact, I just settled one of my last RMBS cases last week. We got the dismissal order yesterday. So that tells you how long some of those have gone on. But what we basically saw prior to the run-up in 2008, in my view, was the collateralization of debt. I like to call it alchemy, right? Taking debt and turning it into equity through an ABS structure. And then once those waterfalls dried up, immense amounts of litigation around that collateralized debt, but especially in the RMBS market in the U.S. And so those disputes have started to come to an end. They're almost completely done, just in time for probably the next crisis. But we've learned a lot of lessons in those 10 or 12 years, 13 in some cases, since some of the first offshore funds went down in 2007.
Thanks, John. Chris, over to you for the insolvency perspective.
Yeah, so I agree with John that 2008 was all about liquidity. In the case of that crisis, I think it's going to be interesting. We're going to talk later about whether we're going to see another liquidity crisis going into 2021. The big case I was involved in was Lehman, which kept us busy for many years. We were on for Lehman Brothers Limited, which was one of the four main Lehman entities in the waterfall litigation, which we took to the Supreme Court where we were ultimately successful. And I don't like to talk about the fact that we were unsuccessful in the first instance in Court of Appeal, but we got there in the end. And that was it. So Lehman Brothers Limited was an unlimited company, which is obviously highly unusual. And we made law on that point that probably won't be considered again for several generations. But I'd like to think that there were other issues that will be determined, that were determined, that will be more immediately useful in this crisis that we're entering at the moment. Similarly, and this is in common with the likes of Stanford and Madoff, a lot of good law was made in respect of recognition between different jurisdictions, which again I'd expect to be useful as we come back round to a distressed environment with cross-border issues. And while this time there'll be more jurisdictions that have signed up to UNCITRAL model law, there will still be challenges with increased globalization and just the complexity of the structuring of many entities that we look at. Lehman is obviously renowned for numerous reasons, but one interesting aspect for me as a young lawyer 12 years ago was the role played by distressed debt funds who were buying up insolvency claims in the various Lehman estates, having anticipated that there would be substantial dividends. And in fact, the UK Lehman entity was ultimately solvent and paid interest. Is a first for me as a restructuring lawyer. So this has been seen before, for example, on BCCI. On Lehman, there was huge interest in the debt trading, and ultimately, an awful lot of litigation was driven by the funds wanting to dispute every last issue. We've seen that pattern repeat itself since 2008, and the funds have taken a significant interest in cases such as Al-Ghasabi litigation in Cayman. I think that's only going to get more prominent, and I think for lawyers and financial advisors, that's a good thing.
Thank you, Chris. And that rather neatly leads us on to our second question. So, as with every financial crisis, the aftermath of 2008 saw companies entering insolvency procedures, funds experiencing wave upon wave of redemption requests, and more broadly, stronger spotlights being shone on corporate finances generally. And it therefore gave rise, as ever in a crisis, to a wave of fraud and asset tracing actions on both sides of the Atlantic, often involving, or frequently, I would say, often involving the offshore jurisdictions. So the second question we wanted to discuss was as follows, and perhaps I could start this, and then John, you could input, and then Chris. What fraud and asset tracing disputes did we encounter that arose out of the 2008 crisis? Again, particularly in the financial services fund and offshore spaces. And as from the London perspective, I think we were involved heavily in the second wave of fraud litigation that followed the 2008 crisis. I think Stanford and Madoff have both already been mentioned, and those were prominent cases that we were involved in. But I'd like to talk about something which is slightly different that Jamie Curl and I worked on for a number of years, which was we acted for a major Islamic financial institution in relation to a $1.1 billion dispute against former directors, which involved fraud claims arising out of certain development projects they had financed in Asia, Africa, and the Middle East. And those projects were greenlit during the financial crisis, but before it had begun to take hold strongly. And many of them subsequently failed, both as a result of the fraud, which I'll talk about, but also the economic turmoil. And it was really a tale as old as time, because our client discovered that the directors of the bank had used SPVs they'd incorporated ostensibly to finance the projects, and of which they were the UBOs, as personal cash cows, and they then siphoned off the development funds due to go for the projects to their own pockets via the offshore jurisdictions and ultimately to Switzerland. And so we ended up litigating and tracing those assets for a number of years in the High Court in London, in Jersey. So we had Norwich Pharmacal and Bankers Trust applications all over the place. And also asset tracing and enforcement work across multiple jurisdictions. So France, Luxembourg, Switzerland, Singapore, and various jurisdictions in the Middle East. And I wanted to highlight that case because, firstly, I think it is representative of the sort of thing that we in the London litigation regulatory team were seeing after 2008. But also because, and this is a bit of a plug, so I apologise, it is the sort of case that is ideal for our firm and that we thrive on. and it also involved working hand in glove with some of our offshore firm friends, including Kerry's. And so it's exactly the sort of work we want to continue to do in 2021 and beyond. John, over to you.
Thanks, Charles. And I have to put a little plug in when I hear Chris talk so much about Lehman, because at one point, one of my former partners and I were presenting at a securities event just after the 2000s, it was around 2007, and some of the offshore funds went down, and we decided to have a slide just to sort of excite people, and we said, "Is Lehman next?" It was meant totally to be an attention grab and not seriously, and it turned out to be prophetic. I had that slide framed, so to say that maybe sometimes there is a crystal ball that we have. But with respect, Charles, to your question, what fraud and asset tracing issues do we see arising out of 08? I think, again, we're going to see similar claims today, but what we saw, what I saw certainly following 08 were, again, fraud and sort of fraud-light issues that popped up among the offshore funds. A big one, I've already talked about it, was valuation puffery, right? There's, in law school in the US, they teach us that fair market value is what a willing buyer will pay to a willing seller, both under no compulsion to buy or sell. But that's not the way valuation works in the illiquid markets of hedge fund assets. So we saw a lot of valuation and NAV calculations that they might technically meet the requirements of the fund documents, but they were not realistic in terms of actual asset value. We also saw asset drift. I sold my fund to my institutional investors saying that I was going to invest in blue chip securities. But as I was chasing alpha, I realized I couldn't get where I wanted to go doing that. So I suddenly decided to take 20% of the fund and invested in Brazilian ethanol swaps. And there's nothing wrong with Brazilian ethanol swaps, and they were all perfectly fine, and they were good investments, but they weren't the investments that I told my LP base that I was going to make. We also saw zombie funds, and we did a program on this both in New York and London years ago, that were created by frozen redemptions for unreasonable lengths of time, and that led to lots of both litigation and involuntary insolvency proceedings, where funds would put up the gates, they would freeze redemptions because obviously they would say my assets are temporarily illiquid, and then 8 years later they would still say my assets are temporarily illiquid. Well, if you can't sell your asset for 8 years, then your asset is probably worth zero. And so we saw a lot of litigation around those issues as time went by. Okay, the first few months, the first year, the first 2 years. After that, investors said, no, this isn't right. This zombie fund can't continue indefinitely. And then lastly, and this drove a lot of litigation in this space, we saw clawback disputes. Amongst funds themselves and amongst regulators and others going back after funds. We saw it in the Madoff area where Picard, the trustee, was seeking clawbacks against offshore funds and actually then seeking clawbacks against institutional investors all over the world that were investors in those offshore funds, including especially in the UK. But we also saw clawback disputes amongst the offshore funds themselves and their own investors, where if they were invested in something like, as an example, again, Madoff, if distributions were made, those funds were trying to claw that money back in order to then make distributions pro rata across the LP base. So, the clawback areas, the zombie problems, valuation, and asset drift drove most of the disputes that we were involved in and I was involved in following the credit crisis. And I think some of those same ones we'll talk about in a bit are going to drive the next crisis as well.
Thanks, John. Almost sounds like a movie script with all these talks of zombies and the like. Chris, over to you.
Yeah, I suppose I'm conscious of time, and we're still only in 2008, so I'll crack on. But I suppose the point that occurred to me when you mentioned Norwich Pharmaceuticals, Charles, was I suppose when you guys were still busy with your your disputes. We were using sort of insolvency office holder remedies in multiple jurisdictions. So using sort of 236 in the UK to call directors in and obtain information from them, either in court or an interview, or getting information directly from banks using those powers and equivalents. So in the US, through recognition, or occasionally using those offshore as well. So I think that's sort of not wishing to sell restructuring too hard, but you know, we were very much using those powers in order to get information quickly and bypass a lot of the litigation that we would need to have pursued otherwise in order to pursue our investigations. And then, other than that, we were probably mainly focusing on the protagonists themselves, who had either perpetrated the frauds against companies or been negligent in operating companies. So that's more my viewpoint, Charles.
And as I recall, 1782 applications were pretty rife around that time too, and were pretty helpful. Okay, moving swiftly on. Let's shift the dial up to the present crisis and discuss what we're seeing now in the space and in the dispute space, and where we see things going in the next 12 to 18 months. But before we do, in preparing for this session, John, Chris, and I discussed that even before COVID hit, we were seeing the rumblings of a downturn, particularly in the commercial property sector, and with problems for funds operating in that sector. I think probably the highest profile example in the UK was the collapse of the Woodford Fund, which held a high proportion of its investments in illiquid assets, such as unquoted companies and the like. And of course, when the Guernsey authorities delisted those companies, after they realized that Woodford was using them effectively to avoid fund liquidity requirements, that caused funds collapse. So that's the most prolific example, but it's by no means the only one. We've seen numerous funds and numerous companies fall into a liquidity trap, principally because they've decided to invest in riskier assets, new unquoted companies, property portfolios which end up going bad, infrequently traded shares, and the like. And all of that's become much more popular post-GFC for the reason we all know about, which is the low interest rate environment that's existed since then, which has rendered traditional investments perhaps less palatable than they once were. So that leads me on to my next question for John and Chris. Perhaps John, you could, perhaps Chris, you could go first. Did you see a shift in the disputes landscape even before COVID hit? And if so, what was it?
Yes, very much so. And as you just said, Charles, for me, COVID has just accelerated where we were going anyway. So it remains to be seen whether that's a positive or a negative. Has it intensified the impact, or will it allow us to accelerate out? We're having sort of constant conversations internally at DLA Piper, where my sort of colleagues in finance and M&A, you know, sort of think it's quickly in, quickly out. And as a natural pessimist, as a restructuring lawyer, I'm pretty sure that it's intensified the impact. So yeah, direction of travel was always towards recession, which always brings about an increase in litigation and often fraud. History tells us that always happens. In the light of COVID, the media seem to have forgotten that the global economy was pretty turbulent anyway, and so, in my view, we were already going there. And the consequence of that, and I think this is important for context before we look at disputes. So the context from a restructuring side is we've seen very few businesses that have gone into insolvency processes just because of COVID. If you look at aviation, it was already screwed. If you look at retail, it was already screwed. If you look at healthcare, it was kind of already screwed. So those businesses that have gone into insolvency processes, certainly in the UK, but from speaking to colleagues in other jurisdictions, that they broadly agree, they were in seriously distressed sectors anyway. I think similarly in financial services, in the UK, we'd already seen a significant amount of pressure from regulators on the lower end of the market. So the peer-to-peer lenders and the payday lenders were already under huge pressure. A lot of this was caused by tighter regulation, which perhaps we'll get time to pick up later. So from my perspective, we were beginning to see substantial fraud. In any case, I think, as John said at the beginning, I've been heavily involved in a barrage, acting for several of the limited partner advisory committees, and that is likely, in my view, to run. That was pre-COVID, and that is the start of fraud appearing on the radar, which, if you're a fraud lawyer or a contentious restructuring lawyer, I think it leaves us in a fairly exciting position.
Thanks, Chris. Agree with all of that. John, over to you.
Yes, let me make a quick segue, because I know this conference is primarily made up of fund and business executives and financial executives, and not so much lawyers. So when we talk about Norwich Pharma call orders, or we talk about 1782, what we're referring to are legal processes whereby parties can get disclosure or discovery from other parties, both in the UK in Norwich Pharma call or in the US under Section 1782. So we're happy to chat more about those offline, but those are essentially discovery mechanisms, disclosure mechanisms in the Commonwealth jurisdictions that allow for information to be gleaned from third parties. But to answer Charles's question, is there a shift? Yes, we did see a shift. And I will say that the last few years has shown remarkable steadiness in the financial markets, at least in the US, with respect to disputes. People tend not to sue each other in the US when they're making money, even if there is asset drift and NAV puffery, because they don't know it yet, right? I don't really care if my fund manager invested in that Brazilian ethanol swap if it's making me money. It's when it loses me money that I say, wait a minute, you went in the wrong direction. So for the most part, it's been quiet in the US on the dispute front, with a few exceptions. One, we saw collateralized debt making a huge comeback in the last few years. We saw a big pullback in the market after the credit crisis. And then we saw a comeback. A perfect example is, many of you remember what we used to call subprime loans. Good news is there's no subprime loan anymore. Bad news is there's now non-prime loans, which are the exact same things as subprime loans, only they have a different name to them. So we saw that come back. And in the US, we saw immense amounts of collateralized debt formed, both in the auto loan market and the student loan market. And I've been predicting for many years that those asset-backed securities based on student and auto loans are going to be susceptible when a crisis hits, and I think we're going to see that going forward. Same thing in the mortgage-backed security space. We saw a pullback from the RMBS space, the residential mortgage-backed security space, but we saw huge amounts of collateralized debt obligations being created in the commercial mortgage-backed security space, CMBS. And for reasons we're going to talk about in a few minutes, that's going to be a huge problem given the real estate market globally following the pandemic. Finally, we saw funds performing well on paper. What we don't know is how liquid the underlying assets themselves are. We see a lot of limited partner liquidity, meaning if I want to sell my LP interests, there's lots of investors who want exposure to certain funds. What we haven't seen a lot of yet is when the fund manager goes to sell the underlying asset, what is the liquidity for that asset? So that's uncertain, and will be an interesting test of the system when things begin to turn. And then finally, it's not really as relevant to our issues, but I've seen in my own practice a big uptick in general partner disputes, GP disputes. As funds have performed well and investors want access, suddenly carried interests and other interests in a fund that the GP entity may have and the members of the GP entity may have are suddenly worth more than people thought they would be. And when the value of assets is higher than people think, they tend to fight over them. So we've seen an uptick in general partner level disputes in some of the hedge funds, both onshore and offshore.
Thanks, John. Thanks, Chris. just moving on to COVID, the dreaded COVID. So just quickly, because we've covered some of this in the last question, I think. But just what trends are you both already seeing since the start of this crisis on both sides of the Atlantic in relation to disputes, particularly financial services funds and restructuring type disputes? And perhaps we can start with Chris.
Yeah. So I mean, John, I think just said that I suppose the dispute side in the US was a bit quieter, and I think I would echo that for the UK. And I think that is because the market's been softened by the various government measures that have been brought in many jurisdictions, such as furlough, prohibitions on enforcement, and relaxation of directors' duties. And as a consequence, there's been there hasn't been a huge uptick in formal insolvency in onshore jurisdictions. I think in the UK, though, those schemes are generally going to be kept going until the spring. What we have seen is a bit more engagement in the offshore jurisdictions, where there aren't similar prohibitions on enforcement. So I think strategies have focused on using insolvency remedies in BVI, for example, because you can continue with petitions there, which you can't necessarily do in the UK. We have, however, seen a rise in very substantial fraud-driven mandates where there is fraud or allegations of fraud, and I think the best example is the one that John mentioned at the outset, which is NMC Health PLC, which appears to have been the victim of a $4.5 billion fraud perpetrated against it. UAE seems to be at the centre of this and other similar situations. Obviously, Abraj was operated out of UAE as well. So I would expect to see a continuing concentration of mandates coming from that region. I think the other thing is I've been paying a lot more attention to the short sellers like Muddy Waters and Value Walk, who have been correct in spotting situations at Wirecard, at NMC, etc. So I may have been late to the party, but I'm certainly taking a lot more interest in what they're saying. I think the other interesting issue on this point is the impact of greater global finance regulation since the 2008 credit crisis, especially in relation to financial services. So the governments globally have introduced huge amounts of legislation to avoid another 2008 situation. We obviously don't know the impact of that yet and whether it will reduce frauds and disputes. My feeling, and I'd be interested to know what you and John think of this, Charles, is that I think a lot has just moved to unregulated activity, and we'll still see a steady flow of activity. But I'll put that question back to you if that's okay.
John, over to you.
Yeah, and I can try to help answer that. The broad question, what trends are we seeing? I have been surprised in that the broadest trend is that liquidity has not yet surfaced as an issue during what by any account is the largest global slowdown in economic activity in our lifetime, in generations. So I think institutional investor patience has played into that, meaning that it's not as if it's a one country or it's a one issue problem. It's a global pandemic. It's a global problem. And really, where do you race? There is no safe haven to some extent to race to. But we've seen a few trends that I think we can highlight. One, I've seen, which is, it's a little bit counterintuitive, but I've seen more of a movement into alternative asset classes in the last year. As investors start to seek not necessarily a safe haven, but a place to get some better return on their investment, a better ROI than they can get, say, in the securities markets or in the debt markets or buying sovereign debt. And so that's led to, from my experience, movement into things like virtual currencies, and movement into things like alternative asset funds like litigation funding. Both of those have seen a big boom since COVID hit, which again might be a little bit counterintuitive, but it assumes that we're in a normal environment where investors are looking for a greater return as opposed to just hunkering down. The other thing, and it's very hard to quantify, is we've seen incredibly uneven performance across asset classes, right? And the easy answer is, or the easy example is, online retail is not in the same bucket right now as travel or tourism and hospitality. One has absolutely zero revenue, and one has 100x revenue compared to where they were. So although we're seeing a slowdown, it's uneven across industries, it's uneven across the workforce, and it's certainly uneven across asset classes. So I think those trends will accelerate depending on how long we're in this downturn. But I think at the moment, institutional investor patience has really kept the disputes at bay so far.
Thanks, John. All very, very interesting. Just moving on to, again, our final question, which does overlap slightly with the previous one, but it's more horizon scanning. So what do we expect to see over the next 12 to 18 months in the fund and offshore disputes landscape as the world emerges from COVID? And what differences did we see from what we saw in 2008? I think we all agree that, like, as John just said, this isn't yet a crisis of liquidity. And so certainly over this side of the pond, we don't expect to see the sort of scale of big ticket financial services litigation that we saw and were involved in post 2008. So the trends are slightly different this time, and apologies, we're going to have to be slightly impressionistic about it, given where we are in the narrative. But certainly from our experience during the crisis, many companies, including investment funds, firstly sort of reacted quite strongly to COVID, and tried to protect their positions pretty aggressively. When underlying assets underperformed, for example, as a result of the ructions caused by the pandemic and particularly the government action. And we in London were pretty busy certainly from March till June, I would say, positioning companies by serving less before action, alleging things like force majeure and frustration, to three words which I'm sure everyone here is sick to death of hearing, and defending allegations of that sort of nature. But after that initial salvo of aggression, what we've seen is interesting, and I think this echoes what John was just saying, that companies are now tending to see COVID, from our in our experience, as a temporary issue in respect to which they shouldn't take the nuclear option of litigation, but rather they should try and reach amicable solutions with their counterparties to avoid that, because they're going to want to work with these people, or they're going to want to invest with these people after this is over. So the big question, the multi-billion-dollar question, I suppose, is how long that's going to last. If as we expect, that the economic shockwaves from the pandemic continue, we would at least expect to see some sort of uptick in those sort of amicable settlements falling apart, and the associated litigation. And we think there is going to be a time lag for those proceedings, as there was in 2008, for at least 12, possibly 18 months. And also, just to loop back into what we were saying before, this is the sort of era where we would also expect to see an uptick in fraud and asset tracing instructions, as companies enter insolvency or even distressed restructuring and identify misappropriations that have hitherto been kept under wraps or hidden by the perpetrators. And again, that's consistent with what we saw in 2008. And finally, and I think this has been briefly mentioned by John, COVID has, of course, if it hasn't already, it will leave many companies, funds, and others with distressed balance sheets. And we therefore think that to the extent those companies do want to go and prosecute litigation against counterparties or defend themselves, that third-party litigation funding is going to continue its rapid ascent on both sides of the Atlantic, as companies seek to recover losses they've incurred during the crisis without the immediate balance sheet and cash flow hit. And again, apologies for the plug, but DLA, as some of you might know, has recently itself launched a $150 million fund, which is already generating quite a lot of interest in this space, particularly from the fraud and fraud and insolvency matters. John and Chris, your thoughts on where we're going to be in 18 months' time?
So it's John. A few things. One, I think something has to give. I've been through enough business cycles to know you can't have consumer-backed debt perform in the long term if you have a slowdown in the unemployment rate that we have now globally. So where are those problems going to surface? Number one, I mentioned CMBS. I think we are going to have issues in that market as demand for commercial real estate likely falls due to the virus. I think most companies have figured out they don't need as much office space as they once thought they did. That's going to result in empty real estate. That's going to result in reduced revenue, and that's going to result in the waterfalls for some CMBS structures drying up. Not all of them, but I think we are going to see some CMBS issues similar to the RMBS problems we had in 2008 and beyond. I think, like we did a little bit in 2008, we're going to see some credit default swap turmoil as investors try to short the bond market yet again. I see, as a practical matter, those disputes ending up as investors who bought CDS against CDS issuers who don't have the collateral, the assets required to pay off all the claims. I see disputes over certain triggers within the CDS structure. And certainly you can see investors looking to the CDS issuers, both onshore and offshore particularly in Bermuda, to cover losses that just are not going to be covered. And then lastly, on this topic, I think we are going to see lots of litigation, but I think more importantly, I think we're going to see, and this echoes what Chris and Charles were saying, I think we're going to see more workouts and market solutions. The credit crisis, when it came to an end, towards the end of it, we saw a lot more market oriented results instead of insolvency and liquidation. That meant purchasing LP interests on the third-party market. That meant investors willing to take risk with respect to distressed assets rather than fight over insolvency or litigation. And finally, it meant investors willing to work in voluntary wind downs or solutions rather than go through the litigation process. So I think what we saw at the tail end of the credit crisis with respect to workouts and market solutions are probably going to dominate the front end of the crisis starting now in 2020.
Thanks, John. Chris.
Yeah, I mean, violent agreement with both of you. I think we'll see more high-profile cross-border insolvencies, driven by either fraud or generally a reduction in demand in certain sectors, the sort of sectors that we've talked about: retail, aviation, commercial real estate. But I don't expect to see that until the various government schemes and initiatives that I've talked about, which are common in many jurisdictions, come to an end. So I think the most optimistic I can be is that we'll see a ramp up during Q2 of 2021. But I have spoken to people in the market who think it's more likely to be towards the end of 2021 until we see that. And I think, as a restructuring lawyer, I think there's an awful lot of companies that need to be dealt with. We were talking about zombie funds before, but there's also zombie companies that have managed to continue since the last crisis and really need to be restructured or frankly liquidated. I do think we'll see more fraud. We've seen from Abraj, we've seen from NMC that there are still large-scale frauds that have been identified and will need to be dealt with. I think your point about litigation funding, Charles, is very valid. And actually, during the 2008 crisis, the litigation funding market, certainly on the restructuring side, was less sophisticated than it is now, and it will just allow us to bring claims in many jurisdictions that we wouldn't have considered last time round. So that will necessarily increase litigation. think, as I said earlier, that the recognition processes are just so much more sophisticated, that will also be easier to bring litigation in other jurisdictions. I think on a pure restructuring side, it's going to be interesting to see which jurisdictions people choose, because we've managed to get 44 minutes through this without talking about Brexit. But there's going to be various schemes on offer in Germany, in the Netherlands. We're seeing the use of proceedings in ADGM in Abu Dhabi. So it's going to be it's going to be very interesting how things pan out.
So with that, our time is up. Thank you, everybody, for participating, and we hope everyone has a great rest of your day.
Thanks for watching. Consider subscribing to our investigative news and documents service and attending our events. For more information, visit offshorealert.com.